Cast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. My name is Rishi Nathani. I'm Head Business Development and Marketing at MCX. It's indeed a pleasure to welcome you to this webinar today on commodity indices and how they can help you in your portfolio. We have a very interesting and experienced panel with us. We have Mr. Abhishek Bansal, Mr. Naveen Mathur, and Mr. Viral Shah. I will give you the introductions a bit later. First, I'd like to speak broadly about commodity markets and about our indices and how they can help you in your overall investment experience. So commodity markets worldwide have been around for long. In India also, they've been around for centuries. However, in the electronic form, we've just been around for the last 16 years as regulated commodity derivative exchanges. Now, commodities are somewhat of an enigma to various investors and market participants in the sense that not many people are very well aware of commodities. So through events like these, we try to do our best to make people aware of the commodity markets and how they can help in the overall portfolio diversification and management. Now, in any portfolio, you should have as many asset classes as possible because there are not many asset classes available. So you'll have your standard equities, currencies, fixed income securities, insurance, real estate, but you also have commodities. Like when you have a thali, it is always better to have one more item in your thali. Similarly, in your portfolio, it's always better to have one more asset class like commodities. Another advantage of having commodities in your portfolio is that commodities are having a very negative correlation to equities and bonds over the long run. So in that sense, adding commodities to your portfolio reduces the standard deviation of your portfolio or the risk of your portfolio and helps you diversify your portfolio to a large extent. The commodity markets also have a wider participant base because in other markets, you will generally find, like equities and bonds, you generally find issuers and investors. But in commodity markets, you'll also find exporters, importers, producers, manufacturers, consumers, hedgers, local traders. So you'll find farmers, farm produce organizations. So you'll find a lot of more participants in the commodity markets. That is why the commodity markets are so vibrant and they are growing by the day. My only point is that equity markets in the electronic form have been around for 26 years. We've been around for 16 years. So at the pace, give us another 10 years and you see how fast and how brilliantly the commodity markets also grow, both in terms of depth, liquidity, participation, and products. The commodity markets came under SEBI in 2015, and thereafter we've seen steady growth, both in terms of products and participants. In terms of participants, earlier we had only corporates and individuals were allowed, but thereafter we saw category 3 AIFs, which are also hedge funds coming in. Then after hedge funds, you saw PMS, mutual funds being permitted, banks as PCMs, bank broking, subsidiaries, and then custodians were allowed into the commodity markets. And we have seen a lot of widespread participation. 2 mutual funds have also come out with commodity-related schemes as well. In terms of products, earlier we only had index futures. We only had commodity futures, then we had options on futures, then we had options on goods, and now we have index futures. So we are seeing that commodity markets are growing at a very fast clip, and that commodity markets worldwide are pretty large. They constitute roughly around 24% of the overall derivatives markets. And in India, that's not even 4%. So we expect that with all these measures that the regulator is taking and the exchanges are working very hard to add more products and participants, we are sure that the commodity markets share in the overall market, derivatives market, will increase. Now, without going further into more detail, I'll just briefly touch upon our indices. So MCX has launched futures on indices. We launched our first index futures on bullion, which is called the MCX HighComDex BullDex. Now, this was launched on 24th August. We had a resounding success in our launch, and thereafter also we are seeing very healthy volumes and healthy participation. Now, this BullDex constitutes of gold and silver in a ratio of roughly 70-30, gold to silver, and you can access it as a portfolio approach. It's a small lot size of 50, so the overall lot value would be around 7.5-8 lakh rupees with a margin of between 1 and 1.25 lakhs. And it is a cash settled product which brings about a lot of advantages for various investors. Now we are going to launch our MCX ICOMDEX Metal Dex on Monday, the 19th of October. Now this is also unique in its sense because it contains all the 5 base metals traded in an MCX: copper, lead, zinc, aluminium, and nickel. This also is a cash settled product, so basically you can trade till the last minute without any delivery or increase in margins in the tender period. Now, so I request all of you to please look at these indices, study them, and if you find them worthwhile, please do participate. Now I'd like to introduce our panelists for today. We have Mr. Abhishek Bansal, who's a first-gen entrepreneur and founder chairman of Abans Group, quintessential diversified business group providing expertise in broking, non-banking financial services, agro-commodity services, warehousing, realty, infrastructure, bolt ore refinery and manufacturing, and trading in metal products, pharmaceuticals, software development, and wealth management. Welcome, Mr. Bansal. We also have with us Mr. Naveen Mathur, who's a director, commodities and currencies at Anand Rathi Shares and Stockbrokers Limited. He's a seasoned professional with extensive experience in commodities and currency broking, building businesses and teams with 26 years of financial market and related activities experience. He has extensive experience in building businesses from scratch across organizations. He's also chairman of the CPEI Commodity Participants Association of India Western Region. We have, last but not the least, we have with us Mr. Viral Shah, who's heading the commodities and forex vertical at IIFL Wealth Management. And he's been part of this commodity derivatives ecosystem since its inception in 2004. In a career spanning over 15 years, he has brokered for clients across various asset classes like equities, commodities, forex, physical power in both domestic and international exchanges. He has extensive knowledge in areas of commodity hedging, price risk management, portfolio diversification, commodities trading, and product innovation. Welcome, Viral, Naveen, and Abhishek. Thank you for being here and taking part in this panel discussion. I'd like to start off with some questions to our panelists, but before that, one of our panelists, Naveen, has a small presentation to show you. So I'd request Naveen that if we can start your presentation and then I can take up the questions. Naveen, you're on mute.
Thank you very much. Thank you very much, Rishi. Yeah, it's just a 3-slide presentation. Just give me a minute. I'm screen sharing that. Can you see that? The slides, Rishi?
I can see your screen. The slide is yet to open.
Anyway, you can continue with some with Abhishek or Viral. Meanwhile, I'll definitely put in.
So Abhishek, first question comes to you: is that there are opportunities in commodities markets now? How important are commodities as an asset class for investors?
Thank you, Rishi, and thank you for your kind introduction. Welcome, guys. I'm not able to see all the attendees, but a very warm welcome to all of you all to this Metal Comdex webinar. Yeah, commodities, as you rightly mentioned, Rishi, in your introduction speech, it's a less understood asset class till date in India. And I suppose investors are still not fully and completely aware of this asset class, and they are sort of apprehensive towards investing in this asset class. And that's what we have seen. We have not seen to the realist extent retail participation in MCX futures. Although after the lockdown, we have seen highly encouraging signs in enough participation and a phenomenal increase in participation on the gold ETF front. Like every day, I see that there is almost about 150 kgs of gold ETF that is being sort of consumed. And the NAV, sort of the AUM is increasing all across the ETFs by about 100 to 150 kgs of gold every day. especially after the lockdown, in the lockdown. So that are encouraging signs that the investors are having their faith in gold, and they believe that the prices of gold will go up in the long run. Apart from gold, obviously we have silver, which has seen a phenomenal run, and we have almost seen silver rise about 60 to 70% in the last 6 months and odd, and it's phenomenal rise at what we have seen. Also, the commodity silver was subdued for the last 4-5 years, so I think so it has sort of given its due return to the investors who were sitting without any return for the last 5 years. But more so about, apart from gold and silver, if you see commodities as an asset class, the third commodity which you can qualify as an asset class apart from gold and silver is copper, which in the US market also qualifies as a investment grade commodity. Apart from gold, silver, and copper, if you see the other commodities, there are not enough sophisticated instruments made to hold on to these assets or to invest in these assets for retail investors. For gold and silver, for example, in India, we still don't have silver ETFs, and we just have gold ETFs. So it's difficult for retail investors to invest in silver in that case, and they can then come to MCX futures to invest in silver. But retail investors are generally wary of futures as an asset class to invest, where you are highly leveraged and you have to sort of have an obligation to pay mark to mark every day. So I think so it's high time that we look towards silver ETF as an asset class and get it listed on the stock exchanges like gold ETF. Apart from that, we don't have copper ETF, we don't have the base metals ETFs. For base metal ETF, it is quite difficult because the commodities are highly bulky in nature. So it is difficult to launch an ETF, although it can be launched, but those ETFs have not been successful in the international markets as well. So in that context, the commodity index, which iComdex is the brand for commodity indices, offers a valid proposition to the investors or to the traders to invest in a basket of base metals or precious metals, whatever the investors are looking for, and thereby participate in the gains or the downside, whatever the investor deemed fit to be, what his view is in the market. So indices then offer a sort of a fair chance to the investors, as in context to what Nifty does. Like if you just want to participate in the broader rally of the economic run of India, and if you are bullish on the economy of India, you just don't have to stock pick, you just buy Nifty and you will participate in the bull run of the economy of India. The same way, if you want to participate in the bull run of base metals or bullion, just don't go here and there, just buy an index future and you can participate in the bull run or the bear run, whichever you think so is your viewpoint. But these are complex instruments. One needs to understand them like cash settled instruments. They are similar to Nifty. Still, I suppose a lot of awareness needs to kick in for the commodities markets amongst the retail investors. Still, commodities futures market is heavily dominated by institutional players or high net worth individuals or family offices. And the retail investor has been dissuaded away from the markets. And one of the major reasons, I think, is CTT. The commodities transaction tax has really sort of demotivated investors to sort of trade in these markets because the cost of trading is very expensive. Although after commodities market, getting regulated by SEBI, we have seen an array of reforms in the commodities market where the options got introduced, the index futures have got introduced. And you can have only one entity now for equities and commodities markets. Previously, we had to have two entities. One was for SEBI and one was for FMC. So lot of reforms have kicked in, and but I suppose a lot of further reforms also are required for sort of full capitalization or full development of commodities markets. Without the development of commodities markets, I don't think so what our goal is to become a $5 trillion economy can be achieved. Because if you see in the US markets also, no country has become a developed economy or a superpower without the emergence of the commodities derivatives market. If you see China, if you see US, or if you see the UK, these are either consuming economies or exporting economies, and they have to have sort of emergence of their commodities derivatives market. Just to put things in perspective for Indian context, India consumes about 25% of the global consumption of gold across the world. Still, the prices of the gold are quoted in dollars, and the price discovery is happening in the international markets on US, on Chicago Mercantile Exchange. Now, we have to ask a question to ourselves that if we are consuming about 25% of a commodity worldwide, why can't we dominate the price of it? Why can't we be the price maker? Why can't the price be determined on MCX? And there should be a day where the US participants are glued to their screens when MCX opens, and they have to see what are the prices of MCX and then sort of derive the COMEX prices on their platform, and not vice versa. We are the consumers, we are a consuming economy, and the consumer has to dictate prices. US neither consumes gold, neither they produce gold, but still gold is quoted in dollars and the price is discovered on the US exchanges. Now we have to understand how US has been able to achieve this situation, this sort of dominance in the global markets and commodities market. And if you see, the commodities transaction tax or the commodities transaction cost is highest in the world in India. If you see, the exchequer earns about 800 to 1,000 crores per annum by commodities transaction tax. But if you see the cost benefit analysis, I suppose the exchequer loses a lot in terms of its negotiation power in the global economic forums if you become a price dictator. And I think so 1,000 crore or 800 to 1,000 crore is a it's not a big amount that the exchequer is earning to forego its position of becoming a dominant force in global economic forum, and thereby able to negotiate trade terms better on a global economic platform. I think so if we can have this sort of understanding, commodities market is, India is a consuming economy of about 125 crore people. How can we not develop the commodities derivatives market and become a super economy or a superpower or a $5 trillion economy is a question that we need to ask ourselves. And I really appreciate the efforts of MCX in launching Indices futures, because these things help to sort of get liquidity in the markets, to broaden the markets, to sort of broaden the horizon of the markets. Obviously, we are welcoming steps of SEBI of allowing AIF category 3 to participate in the commodities markets. Such sort of steps are encouraged and they are very well welcomed. And these things can just enable India to become a superpower one day, which we all Indians dream of. Over to you, Rishi. Thank you so much.
Thanks, Abhishek. Thanks for that very comprehensive viewpoint. And key takeaways I got was that India needs to have that pricing power. So as we say at MCX, that Make in India can be successful only when we trade in India and price in India. So we have to have the trading power and the pricing power. Trading of commodities has to grow in India. And as I said earlier, it's just been 16 years. Give us another 10 and see where we go. We are growing from strength to strength. And in terms of getting there, we are going step by step. So from futures, you're getting to commodity indices, which allow investors to get a portfolio approach. Now I'll come to you, Viral, that within the same theme that you have HNIs, you have retail, you have everyone in this market. Now, what are the advantages of these sectoral or thematic commodity indices in a portfolio, like you're seeing the Bulldex, which is a bullion index, or the Metal Dex, which is the index of base metals? How do you see it as thematic element to the portfolio? Viral, you have to unmute.
First of all, thanks, Rishi, for inviting me to the panel, and thanks for the warm introduction. First of all, I would like to just take a step back and go back to the theme of the discussion, which is commodity indices and usage in portfolio diversification. In the Indian context, we have always been extremely heavy when it comes to debt and equity as part of the portfolio allocation, along with real estate. And I think probably in the month of January or February of 2020, the World Gold Council had come out with a very interesting report on gold as a means of portfolio diversification. Or, how do you quantify a number and say that this much of portfolio diversification should be there in commodities segment? And the number had come in the vicinity of about 6 to 10%. And obviously, there were a lot of studies in terms of the standard deviation and how does it add up to the portfolio part of it. But unfortunately, what happens is when we then talk about the global context versus the Indian context, that entire allocation, as people are doing it from the institutional side or from the retail side, is the allocation is happening in only gold and not in the larger commodity basket. And one of the reasons, as what Abhishek has pointed out, is we have various investment opportunities to participate in gold, which includes the sovereign gold bonds, the ETFs, and the gold futures, versus not many other products are available in the domestic context. We don't have ETFs on other commodities. We don't have any other structured products that we can participate. Now, if you take the global theme of how the commodities indices play out, commodities essentially are more of a tactical allocation to a portfolio. People participate in commodities like in the current context where because of the monetary and fiscal stimulus across the world, there is an inflation expectation building in for the next 2 or 3 years. And people want to have allocation to commodities as a hedge against that inflationary trend. Now, gold obviously will be one of the star performers, but it doesn't rule out that agri-commodities or industrial metals like copper, zinc and all should not also benefit from this surge in inflation. And we should have innovative products in where corporates, institutions, retail, HNI, all these segments can participate in a seamless manner. And that is where commodity indices play a very pivotal role. Globally, obviously, indices have been there for a very long period of time. They are broad-based, they have energy, they have base metals, they have precious metals, they have agricultural commodities. And I think even MCX will, in the near future, launch such products. But even in the current context, the two indices which have been launched, or the metal desk is getting launched, where you can now have an allocation to commodities through an index, which is cash settled. It does not need to go into the physical delivery aspect of it. Slowly, steadily, people will realize the benefits of entering into these futures contracts and holding it on for a period of 3 months, 6 months, 10 months, depending upon the time horizon and the tactical nature of their investments. And it will be a very interesting opportunity for market participants like us to educate our clients, to demonstrate as to how holding these index with or without leverage can actually benefit the client's portfolios. Coming to the specific index which is going to get launched very soon, which is the metal index. Metals are obviously the barometer of the industrial activity. And from the March and April lows globally in the metals market, whether it is copper or zinc or lead, we have actually come to a pre-COVID pricing right now. And if the fiscal stimulus in the US and in other parts of the world go on in 2021, we could potentially see an upsurge in the metal prices from here as well. And there are many clients who are wanting to take positions in such commodities, but because of the poor investment opportunities available in India, either you buy the futures of these contracts and hold it or roll it over. Again, weightage has become a problem. The allocation effect becomes a problem. So the launch of this index will stimulate a lot of passive money which wants to get into commodities without getting into the nitty-gritties of which asset to buy, how much to allocate and all, because the index already is pre-decided on that part, basis the underlying value, underlying volumes that are happening in these contracts. And that is where it will become a very pivotal role of how the next round of investments comes into the commodities market. If you go again by the perspective of the international markets, where you have a lot of ETFs, which are passive investments onto the commodity index. So you have the S&P commodity index, where more than, I think, about $50 to $60 billion of assets are linked to the performance of the index. You will similarly have alternative investment managers using the mutual fund or the portfolio management services route or the AIF route to actually start buying and creating ETF products which are linked to the index itself. And I'm sure that as the liquidity depth increases, you will see much more sophisticated products coming in into the markets to benefit from such kind of investment opportunities. So these are very, very essential tools for asset allocation. Obviously, it would be left to the fund managers to decide as to how they would want to participate in a tactical approach or a long-term approach when they buy these futures contracts on the indices itself. But by and large, both the sectoral index, which is the bullion index, and the metal index are the right products at the right time.
So just a follow-up question, Viral, that well said that first of all, just to summarize that, these indices can act as a substitute for ETFs, as Abhishek had also said earlier. Base metal ETFs are very difficult because of storage costs, etc. So these indices can act as a quasi ETF, and people can take portfolio approach to them. Now, you also said about various AIFs and other large investors creating products around them. So how do you think that commodity indices can be used for designing structured products for the clients?
So like I said, basis what is the theme of the portfolio manager. If he is looking somewhere to create a product which would be more about beating the inflation over the next 1 or 2 years, and therein he would want to have an exposure to commodities. Earlier, beating the inflation would also be in terms of having an indirect exposure to commodities through commodity stocks and so on and so forth. But here we can have a direct exposure to the underlying constituents of the index. So by the virtue of the fact that the base metal index has almost a 2/3 allocation to zinc and copper, and these two are consumption-driven stocks. If the global economy were to recover in 2021, and there would be an increased spending by the governments on the infra side, we are sure to see a higher numbers on copper and zinc for 2021 itself. And that is how you would see a little bit of a tactical allocation. Structured products could come in as not as the primary thing, but as a secondary thing, because in order to create a structured product linked to an index or similar to what we have more on the equity side, you will also need to have NBFCs or banks participating in the commodities markets where they are able to issue products around the index. Till the time you don't get to see depth, liquidity, and also far dated contracts in these products, at least about 6 month, 9 month volume and open interest in these products, it will be difficult to assume structured products would come in as the first step. But at the same time, we are taking the first step to allowing for HNIs and retail participants to get in, followed by mutual fund managers who would possibly look at it from an asset allocation perspective of having a certain amount of exposure in the commodity index. And then you would see the growth of the structured products. So it will be in stage 3, but at least we are at stage 1, which is very good.
Great. So we are getting there. Naveen, coming to you, would you like to start your presentation first, or you'd like me to ask you a question? You have to unmute. Naveen, you need to unmute.
In us to be part of this particular forum, must appreciate the efforts of the exchange, and at the same time, the congratulations to you and the entire team of MCX for having an astounding launch of the Bulldex. Beautiful product, a retail product, 7.5-8 lakhs worth of the lot size, which give you access of price trends on both the gold and silver. And in advance, congratulations for the success of the Metal Dex, which we are going to launch on the October 19th, Monday, this month. See, I think the moot point of this particular discussion is that commodity indices enhanced tool for the portfolio management. Rishi, we always have seen and been talking about including commodities as an alternate asset class, and what Viral said, 10 to 15% of that particular asset should be part of your corpus as an allocation. Indices, actually, what Abhishek said and what Viral said is absolutely right. And in the right direction, therefore, the indices really make good of what you are talking about as a portfolio diversification. A 50 lakh contract on gold used to cost us around 5 lakhs versus then silver together, just the lot size of 8 lakhs cost me around 80,000 or a lakh. So when it comes to portfolio allocation, it majorly helps us that can take exposure nature of the commodities, like Abhishek said, that we don't have ETFs, but you have Buldex, which is the underlying price trend of gold and silver. And similarly, for the metals, if you really want to take it forward in terms of your portfolio investment on the metals, I think this particular index would do pretty well. And together, both the indices on the bullion and on the metals, I think, would do a great stuff for people to actually, these indices would lure people for doing their asset management, which was not possible because of many barriers with us. So I think except for the physical gold or the physical silver as part of your portfolio, you didn't have anything. So with a lot size, it will entail people to spend a little, but have an exposure of the commodities on the corporates. I have actually 3 slides for the portfolio diversification, and I would request Nazir if he can share the screen of these 3 presentation slides. Very, very quick discussion on that, and then maybe ending for myself and questions from you. What studies did mention that we say that it's low correlated or negative correlation. Now the commodities per se have 0.19 positive, 0.19 positive to stocks correlation, and even with bonds you have 0.02, which is the relationship of commodities with either stocks S&P 500 index or the bonds, the fixed income at 0.02. Nazir, you can go to the other slide. And now this is something which is a very critical one. One of the studies done, and what Viral said at the start of his session, was that we did talk about the 10 to 15%. He said 10. Means we need to be a little portfolio diversified. It says that incremental additions of managed futures in developed markets, we call commodity derivatives as managed futures to the traditional portfolio. Now, traditional portfolio, if you see, starts with 55% stocks and 45% bonds with 0 commodity derivatives as part of their portfolio, which has a standard deviation of 9.6 or 9.65% on the horizontal line, and on the vertical line you have the returns. Now you have the risk, the highest of the risk, but at the same time the lowest of your returns. Move a little left, incrementally you add 10% of commodities, you change your composition from 55% of stocks to 50% of stocks, and from bond 45% you change it to 40% bonds. Now there is a stark contrast the way returns are adjusted to your risk. You have a little better return and you have curtailed too much of your risk. 10% increment, your returns are approximately 14.5, but at the same time your risk, which is a horizontal line, drastically comes down to an extent of 8.5 or 9. Left corner, the kind of an eye, and the left corner to that where the big arrow is, if this is what we are talking about, 45%, change a little more, add 10% of commodity futures into the business of commodities in part of your corpus, you see a stark difference. Now you see that your returns are inching towards from 14.4 towards 15, and at the same time you have the least risk on your portfolio. So what I'm trying to say, and if you do a little more of managed futures, definitely the economies of scale will work to a certain extent. So at this particular point where the stocks are 45%, where you have the fixed bonds at 35%, and you have managed futures, which are commodities in the developed world, at 20%, you will have a better return with the least risk. So as risk versus returns, you get the best out of this particular combination of 20% commodities, 35% stocks, and 45% stocks and 35% bonds. Just the last slide, Nazir. Now, we all know because of commodities price rise, we see inflation moving up. So it is not a rocket science that if you have commodities, you have a higher inflation. So yes, high commodity prices result into a higher inflation. Now, certain time frames which I have plotted to 2009, and this is a kind of a study done by Prudential, which says that if you have that 20% from the last slide of your corpus, your risk adjusted returns are much better. And if you have 20%, your returns are positive to a tune of some X figure. Now, if I just see it, 72 May and December 74 of an inflation period where the inflation moved up from 3% to 11%, and then 76 to 85 to 14, 86 to 90, 1% to 6%, and 2% to 6% in the times of recession. Now, commodity prices or the commodity performance have been astounding. Means if you see 222%, 186 or 54%, it helps you, therefore, to ensure that if the commodity, if say for example the inflation is up, the central banks or the monetary policy of the central banks would be little hawkish. And by hawkish, I mean that they might go for a rate increase. And if that happens, definitely you will have economy or the credit growth impacted. And maybe the stocks performance, margins go down for the stocks, which may lead to your losses, but at the same time, with a neutralization again on the commodity side. So I'm done with this 3-slide presentation. And why I was showing this, because it makes sense since the topic is the portfolio management or the enhanced tool for portfolio management. So I felt that I should definitely go through with these 3 slides as a basic. And therefore, indices, both on the gold and silver bullion and metals, will actually close in the loop of having commodities as part of the portfolio. Then you're not worried for delivery, and as they are cash settled, you're still gaining the benefit of these indices to be pumped. So with that put, I wish you all the success for the 19th on the launch.
Thank you, Naveen. Very informative slides indeed. Abhishek, welcome back. Next question for you is that should equity investors also look at commodities, and how is blending commodity and equity indices in a portfolio? How does that help in enhancing returns and reducing the portfolio volatility?
Yeah, obviously, it's a no-brainer that the equities and commodities tend to have a negative correlation, and everybody wants to hedge their equity portfolio with gold. So if the equities are going down, the gold should go up, normal convention. But when there was when the COVID news hit the market at that time, we had everything getting sold off. Even gold was getting sold off at that time. So as an investor, one has to understand that once something gets sold or everything is getting sold, gold will also get sold, and so would the other commodities be. But as an investor, one has to understand the fundamentals behind gold or other commodities, that if so much amount of money has been printed in the economy, like just to bail out of the COVID situation, we have printed almost $7 to $10 trillion of money from the US Fed. If so much amount of money has been printed, gold and silver has to, especially gold, the dollar has to devalue against gold. You can see bleeps of gold, getting hammered if there is a loss of confidence in equities, or at some time you can see a sell-off in gold, and that's what we saw when the COVID news hit the market in March. That gold was also getting hammered. But fundamentally, these asset classes, especially bullion, they have a bullish undertone, quite strong undertone beneath it now. After 2008, especially about the quantitative easing, after 2008, the low interest rate regime, and now it is actually coupled with the COVID scenario, where we have the central banks have just left, right, and center printed money. So in that context, gold becomes a natural hedge towards your equity portfolio. And if you want to take a higher beta towards gold, it is silver. But obviously, if if dollar has to get devalued against an asset class, it will be gold, and silver will be a high beta towards gold, which is moreover a speculative asset class to gold. If you see copper also in that context, copper is also a hedge in terms of, because it is now moving from an industrial asset class to an investment asset class. Although the migration is very slow and very sort of steady and slower pace, but copper is now falling under more so as an investment asset class rather than an industrial asset class. But still, these base metals are a precursor, or they are sort of benchmark for the industrial growth that the economy is going through, and which is pretty much evident. If you see, only the copper prices are shooting up in all the base metal pack, and if you see zinc, lead, nickel, aluminium, they are fact aluminium is at low to glass, and these the price. And moving out of the industrial asset class. And so is silver right now. It was an industrial asset class, but slowly, and now it has become an investment asset class. And gold predominantly is an investment asset class. So when we understand all these dynamics, it becomes a great hedge, especially the metal complex future, the base metal complex future, because I believe these base metals, especially aluminium, zinc, lead, nickel, they are at a very low valuations. For example, nickel is quoting at about $15,000, and the production cost, the mine production cost of nickel would be around $9,000 odd. So you are quoting at $15,000, and we expect a bull run in electric vehicles where the batteries are made out of nickel. So we could foresee a demand rush in nickel, which has been the story in nickel for quite a long time, but we haven't seen that bull run in nickel. And same with aluminium. If you see, aluminium prices are rock bottom. They are quoting at $1,800 per ton, which are phenomenally low levels. I believe that one can definitely invest in these base metal at these levels. You can invest in gold and silver, but one has to be wary at these levels and have to take it with a pinch of salt for investing in gold and silver. But obviously, as a hedge against equities, they are good tool. So I would say, as a hedge against equity, gold is the best tool. And so you can have a blend of bullion and base metal portfolio to sort of protect your equity investments. And apart from the protecting your equity investment or hedging against your equity, I think so it's great time to invest in base metals, which is the lead, zinc, nickel, aluminium pack, because these commodities are highly undervalued in context of copper and the other bullion. So yes, the commodity indices futures gives a great opportunity for investors and traders who just want to who just have a view on base metals and just don't want to get into the hassles of delivery and other storage issues. They can just buy the commodity indices, the base metal indices, and participate in the bull run. Over to you, Rishi. Thank you so much.
Thanks, Abhishek. So message loud and clear that you can hedge your equity portfolio through commodities and vice versa. Now coming to you, Viral, are you there? Okay, so I'll come to you, Naveen. Oh, okay, Viral.
Yeah.
Yes. Can you just spend some time explaining the mechanics of the commodity indices and its advantage over the single commodity futures contracts? What is so different about it from a portfolio manager's perspective, and how will these index futures help the commodity markets grow? What is your view?
Sure. So all the contracts which are traded on MCX on commodities like precious metals and base metals, these are compulsory delivery contracts, which means that the expiry of the contract, it results into a physical delivery. And the way SEBI has now structured this entire market is that the delivery actually gets staggered over a period of 5 days. So assuming if the contract is valid for a period of 30 days, 5 days out of that is where the buyers and sellers have to go in for the physical delivery part of it. And that really is the reason why you see every 10-15 days that the retail participants or even the HNI community has to actually move their contracts from one month to the other, which results in could be either a cost of carry, or it could result into a backwardation where the buyers and sellers actually lose out on some amount of money as well. Now, when you come to the index, first of all, because you don't have to participate in individual constituents of the index. Today, if you look at the 5 base metals that are traded, the larger being the copper contract where the value is close to about 12.5 lakhs, and the smaller being the aluminum contract, which is 7 lakhs. It is, you are investing in a wide spectrum of products, and the margin requirement for these products are also high. So when you come to the index where basis the weightages that the index has created, where copper is copper and zinc are close to about 30-35%, followed by lead and nickel at 12 to 14%, and then followed by aluminum, which is at close to about 9%. You have a broad allocation towards the most important constituents of the base metals market. Historically, also, aluminum has not been one of the most volatile commodities. It's always been copper or zinc, which are considered as the barometer of the metals market. And then you have the futures contract on this, on these index. You essentially are participating in a cash settled contract. This is an excess return index, which means it captures the delta or the variance of a particular commodity from a day-to-day perspective. And towards the expiry, you will also see the underlying constituents of the index. So assuming if the index is based on these 5 products and the underlying are the futures contracts of these 5 products, at the end of the expiry, you will also roll out, the index itself will roll out the positions itself. So net, if I were to put it in a very simplistic terms, you are participating in an equivalent contract of the 5 base metals, where you either could be bullish or bearish, and you can express your views according to that. These contracts will settle as per the formula which has been provided by the index market, by the index providers, and it will result in clients getting being able to express themselves very freely. Like today, because of the stimulus, you could expect that the markets could go up by a factor of, let's say, 0.5% or 1% across the board. But instead of buying individual constituents of the index, you can go ahead and buy the index itself. As more and more people participate, you will see better depth, better liquidity. You will see a lot of algo players also who will then, just like Nifty, participates in the index versus the constituents of the index itself. So it is just baby steps, but I'm very, very excited on the index doing well over a period of time.
So like Nifty and Bank Nifty are to equity markets, do you think Bulldex and Metaldex will become that for the commodity markets?
Well, see, the appeal is there. Again, commodities are more tactical allocation. You don't have a bull run in gold. Gold also actually had a bear run between 2011 till 2017, and you had seen a similar scenario even in base metals, although the cycles are shorter than compared to gold and silver. So it's all about tactical allocation. What exactly is your requirement? Are you participating on the long side, on the short side? Are you looking at an inflation play for the next 1 or 2 years? Then commodities makes a lot of sense. And within commodities, now you have the ability to deploy money even through the index, which wasn't there earlier. So yes, it will have its own set of audience. I think for someone to benchmark this indices versus the Nifty and Bank Nifty, I would say it's more inclined towards the Bank Nifty because it's a subset of that, right? Nifty also would have constituents of the Bank Nifty itself, but Bank Nifty is something that you can pitch this to. Also, unlike the equity markets, which trade only for about 6.5 hours a day, this index is close to about 12 hours a day. In fact, it's close to about 15 hours a day. So you will have more opportunities for participants to do an in-out or even to take positions when the global markets are much more active, which is towards the evening. So yes, there will be a very good audience. There will be a very good set of participants who would want to express themselves through the index. But as stakeholders, I'm mentioning it from the perspective that the exchange plus the member brokers at the exchange level, as well as all the other interested participants, we have to really educate our clients on how to utilize it, how to participate in it. And over the next quarter or so, we would really have to work hard to really educate the market participants about the use of these index products.
Great, thanks, Viral. Now coming to you, Naveen, we've seen a very successful launch of the Bull Dex. We are now seeing the Metal Dex coming. What has been the response from your clients till now, and how do you see these products shaping up in terms of volumes, participation, and how do you think that investing in commodity indices can help investors?
Thank you, Rishi. I would say what Viral said actually was that it's a baby step. I would differ with Viral on this. The Bull Dex and the Metal Dex would not be, I would say, would not be wrong to say that they are a much bigger response to what the market needs. These are steps, yes, in the right direction. I think the margin requirement, Rishi, and the contract value itself, as I said earlier, makes people interested to be part of these indices. Kind of comparative analysis of equity and these two indices. I think we are still in a nascent stage. People have not accepted commodities per se as the mainstream of asset class. So therefore, it's always been a tactical investment, as Viral or Abhishek says, or an alternative investment tool for the portfolio management, or maybe the price risk management by the people who use commodity markets for price risk management or so. From the retail perspective, yes, we have seen, and thank you very much, first of all, for your team to be available at all times for making people train on these indices, and people across the branch and the regions have gone through 1 or 2 rounds of training by MCX. So I'm thankful for that to you and your team. Retail participation would definitely come in. I think with the 2 Bull Dex and the Metal Dex now, you will definitely see too much of an activity on the indices, as we see even in equity or the capital markets, where the indices are traded much more in volume with depth than the stocks underlying it. I think it's going to take some time for the people to understand, because the education part, as Abhishek said, is important, and therefore I think days to come might be. But you also have to see to it that you don't cannibalize your normal underlying futures or the options volume to the indices. It's good that we are getting in one lot many compositions of bullion and the base metals. At the same time, I would say that it should not happen that the participation in the major contracts which are underlying commodities for these indices dry up. So I think the retail would definitely be, we would definitely be participating with full vigor and enthusiasm. Thanks, Rishi, over to you.
Yes, Naveen, so thank you for that. And we do expect that because of the indices launch, instead of cannibalization, rather both contracts would benefit because people will participate across. Now, very quickly, since we are running totally out of time, in 30 seconds, I'd like all of you gentlemen to summarize if there is anything to add. So Abhishek, starting with you.
Okay, 30 seconds to summarize the entire conversation. Yeah, I would request all the attendees and members present out here to participate in the bull dex and the metal dex contracts. Obviously, they are great. Instruments to sort of actively participate in the commodities bull run or the bear run, with whatever your view is to the market. But we have to take all these things with a pinch of salt and understand that all these things are possible, and MCX is doing its own part, but everything is possible and can be done to a great extent, and only with the support of the regulator and the government. If the policies of the government are not in coherence with the commodities markets, I think so MCX and participants like us end up, however hard we've tried to do things, but at the end, we require the support of the government and the regulator in the process of making commodities market a powerhouse in itself, which can then help the Indian economy to take a boost in itself. And that's what we have seen in the international market. See, Chinese commodities markets have overtaken London Metal Exchange, which have a history of more than 100 years. And in the span of 10-15 years, the Chinese commodities markets have overtaken in terms of volume and open interest in terms of on base metals. They have grown far beyond than the London Metal Exchange. And why they were able to do that? Because China said that I am consuming 50% of the copper of the global consumption. Production of copper is consumed by China. And right now, it is pretty much evident that Chinese dictate the prices of the copper market. It is not now the benchmarking of the price discovery is not happening on the LME. And more so, if you see Hong Kong Exchange went ahead and bought over the London Metal Exchange, and that's what Chinese wanted, their dominance on the commodities markets. So it's high time that the government and the regulators understand the importance and the dominance of these markets to make India a superpower or a $5 trillion economy. Over to you, Rishi.
Thanks, Abhishek. So basically, the message is loud and clear: Atmanirbhar Bharat. Viral, your closing thoughts.
So I think, as the development of the markets goes, since the last 5 years, we have seen SEBI do a fantastic job in terms of first understanding where the issues were in the development of the markets. Slowly, steadily, they have addressed a key theme, which is the introduction of institutional participants. As the first round, they introduced the institutional participants. They cleared the decks for them to participate in a much more meaningful way without any restrictions on saying to agree or non-agree. And now, as a development stage, they are allowing for products which can be used by institutional participants as well. So I think it's a very good calibrated step-by-step approach. Yes, now the onus is on us, all the stakeholders at the exchange level, to ensure that the message is conveyed to the retail as well as the institutional participants. And best of luck to the MCX team as well. It's been a busy season in terms of new product launches. We hope to see more of these before the end of 2020 as well.
Thanks, Viral. Naveen, over to you. Please unmute.
Nothing much, Rishi. Congratulations for the bull decks. All the best wishes for the metal decks. I'm done.
Thank you so much, gentlemen, and thank you for taking out time and sharing your valuable thoughts and your experience with all of us and our participants. And look forward to many such programs going forward. And with asking all the participants to please look at our indices and definitely participate if they find some value in it. Thank you so much, and
all the best.
Take care of yourselves. Thank you.
All the best, Rishi.
Thank you.
All the best. Bye.
Please provide your feedback before you leave the webinar.